there is a very good chance that you could be saving wrong for retirement. And what I mean by that is that most people make the mistake of saving way too much pre-tax and not focusing on diversifying the types of accounts that they're saving in. It's a big misconception that you'll be in a much lower tax bracket in retirement, as often that's not the case. Avoiding too much in taxes now could be causing a tax time bomb for you down the road, and you could end up paying even more in taxes than originally planned. I'm Amber Knips, a wealth advisor at Sweet Financial in Jackson and Fairmont, Minnesota. And what I do is I specialize in working with people who are at or nearing retirement and are high net worth individuals looking to plan for what's next. We believe everyone has the right to realize that their dreams are possible, and we use that as our driving force when we're thinking about the future and planning for what's to come down the road. I have a relatively new client who is still working. He's a really great earner, and he's always been a great saver. So he has a great nest egg within his 401k. Downside is it's all pre-tax. So within the past few years of working together, we've really talked a lot about taxes and had start shifting of all of his contributions going into the Roth 401k instead. Well, the other day we were having a conversation and he's like, gosh, Amber, I'm paying so much in taxes. Won't I be in a much lower tax bracket in retirement? And I'm like, well, so I put the numbers together and showed where he is tax-wise now and where he will potentially be at in retirement. And he was shocked. He's like, but I thought that was going to be the case. I won't have any income. But when you look at the amounts that have to come out later to cover expenses and required minimum distributions, it's a lot higher than you'd think. So tax planning is so crucial before retirement as well as in retirement. So not just filing our taxes every year, that's a good thing too, but doing more planning in addition to that to make sure that you're saving in the best places and that you're not missing out on something now and regretting it down the road. Because we believe it's a very important thing to focus on paying the least amount of tax over time, not having tunnel vision and wanting to pay the least amount of tax each year. So, as you know, anything that comes out of an IRA or a pre-tax 401k, you have to pay taxes on. So kind of a different way of looking at it is if you have $1 million in a 401k, you really only have maybe 700,000 because you owe taxes on a chunk of that. So since everything that comes out you pay taxes on, think of it as you want to take a big family vacation, taxes. You want to buy a car, taxes. Maybe want to gift to kids or grandkids, more taxes. Because unfortunately, the IRS doesn't think that our kids are very good charities. So when we're looking at wanting flexibility, all in that pre-tax space isn't necessarily the best thing. And when we're looking at flexibility down the road of distribution planning and some of those different things, when we look at how it works with Social Security, taxation of Social Security depends on your other income sources. So if you're taking a ton out of those pre-tax accounts, you're likely going to pay the most tax on Social Security, which is tax on 85% of your benefit. If you're able to be one of those that did a lot of tax planning and now you can structure your income accordingly, you might be able to get the tax that you owe down on your Social Security. So that's where a lot of people potentially get into trouble too, is maybe they're only paying taxes on 50% of Social Security. Well, then they take funds out to take a big trip. Now they owe taxes on the funds they took for the trip, and more Social Security gets brought into the tax equation. So looking at the next couple of years, we have a ton of tax planning opportunities because the Tax Cuts and Jobs Act that's put in place now expires in 2026. So when that happens, tax rates are set to increase back to what they were before that was put in place, which pretty much means a tax increase across the board, but there are some different pockets where it's a drastic increase, especially if you're around the 155,000 to 180,000 of taxable income. So if you're in that case, even more opportunities to say, what should I or could I be doing differently? You have this great window of opportunity. You don't want to miss it. So that's where having a trusted advisor who's knowledgeable in planning is so important to help you work through that and continuously work through that. It's something that we've been working through with all of our clients to say, what could we be doing? And, really taking advantage of those opportunities before they're gone. And, also having the awareness too that tax rates are going to be likely increasing. So keeping that in mind so you don't have that surprise, because I don't know about you, tax surprises are my least favorite kind of surprises. We believe everyone has the right to realize that their dreams are possible, and we want to do that, and we want to help you get there. So we're offering a really great resource, completely no cost to you. It's called our Retirement Readiness Center Toolkit, and you can access that by going to mysweetfinancial.com. And what that does is it starts getting the conversation going of, what do I want my money to be doing for me? What should you be doing differently? And then helping you, think about what's next. And if you found this information valuable, you should check out our other video, 5 Secrets to a Happy Retirement, which flips the script and talks about true happiness.